The silver market has once again captured the attention of investors around the world, but this time the story is about much more than a simple decline in price. Behind every sharp move lies a complex interaction between monetary policy, investor psychology, industrial demand, and global economic expectations. And understanding these forces is far more valuable than reacting emotionally to a red chart. Over the past several weeks, silver has struggled under the weight of a stronger US dollar, elevated Treasury yields, and persistent uncertainty surrounding the Federal Reserve's next policy decisions. For many short-term traders, these developments have created fear that the precious metals rally has reached its end. Yet experienced investors know that financial markets rarely reward those who focus only on today's headlines. Every major correction in the history of precious metals has tested investor conviction before revealing whether the underlying trend was truly broken or simply taking a temporary pause. That is why the current environment deserves careful analysis rather than emotional reactions. Silver occupies a unique position in global markets because it is both a monetary metal and an essential industrial resource. Unlike gold, which is driven primarily by investment demand and central bank activity, silver also benefits from growing consumption across multiple industries, including solar energy, electric vehicles, semiconductor manufacturing, advanced medical equipment, telecommunications, and artificial intelligence infrastructure. This dual role creates opportunities that few other commodities possess. When economic growth accelerates, industrial demand can support prices. And when financial uncertainty rises, investment demand often returns as investors seek assets that may help diversify portfolios. However, these two sources of demand do not always move together, which explains why silver is often more volatile than gold. During periods of rising interest rates, investors typically reduce exposure to assets that generate no income because higher bond yields become more attractive. This relationship has placed pressure on precious metals as markets continuously reassess when central banks may begin easing monetary policy. Inflation remains one of the most closely watched variables because it directly influences expectations for future interest rates. If inflation remains stubbornly high, policymakers may keep borrowing costs elevated for longer than investors previously expected, supporting the dollar and weighing on silver. On the other hand, if inflation continues moderating while economic growth slows, expectations for lower rates could quickly change investor sentiment and encourage renewed interest in precious metals. Markets constantly attempt to price future expectations rather than present conditions, making every economic report capable of shifting sentiment within minutes. Yet experienced institutional investors rarely make long-term decisions based on a single data release. Instead, they analyze broader trends across inflation, employment, manufacturing, consumer spending, credit conditions, and business investment before adjusting portfolios. This longer-term perspective often separates disciplined investing from emotional trading. Another important factor often overlooked is the physical silver market itself. While financial headlines focus on futures contracts and daily price movements, industrial consumers continue purchasing silver because production cannot simply stop whenever prices become volatile. Manufacturers producing solar panels, electronics, and specialized technology components require consistent supplies regardless of market sentiment. Mining companies, meanwhile, face rising production costs, declining ore grades, environmental regulations, and permitting challenges that can limit future supply growth. If industrial demand continues expanding while mine production struggles to keep pace, the longer-term balance between supply and demand may become increasingly supportive for prices. This does not guarantee immediate gains, but it reminds investors that daily market movements represent only one part of a much larger picture. History repeatedly demonstrates that the greatest opportunities often appear during periods when confidence is weakest. During previous market cycles, silver experienced sharp corrections that convinced many investors the bull market had ended, only to recover once macroeconomic conditions shifted. Of course, history never repeats perfectly, and no responsible analyst should assume the future will unfold exactly as it has before. Every cycle contains unique economic conditions, different monetary policies, changing geopolitical risks, and evolving industrial demand. Nevertheless, historical comparisons remain valuable because they help investors understand how markets tend to behave when fear dominates decision-making. Investor psychology itself plays an enormous role in precious metals. When prices rise rapidly, optimism attracts additional buyers who fear missing further gains. When prices decline, that optimism often transforms into pessimism just as quickly, encouraging panic selling, precisely when long-term investors begin looking for value. This emotional cycle has repeated throughout financial history across stocks, commodities, real estate, and currencies. Successful investors recognize that markets are influenced not only by economic fundamentals, but also by human behavior. Fear and greed frequently create temporary price movements that exceed what underlying fundamentals alone would justify. Looking ahead, several important developments deserve close attention. Inflation reports, labor market data, Federal Reserve communications, Treasury yield movements, and the performance of the US dollar will continue influencing short-term market direction. At the same time, investors should monitor industrial demand trends, mining supply, exchange-traded fund flows, and broader global economic conditions. If economic growth slows while inflation continues easing, expectations surrounding future monetary policy could change significantly, potentially improving sentiment toward precious metals. Conversely, if inflation remains persistent and policymakers maintain restrictive conditions for an extended period, volatility may continue before markets establish a more durable trend. Neither outcome is guaranteed, which is why disciplined investors prepare for multiple scenarios rather than betting everything on a single prediction. In financial markets, certainty is an illusion, but preparation is a powerful advantage. Understanding both risks and opportunities allows investors to make decisions based on evidence instead of emotion, and that mindset has consistently proven more valuable than attempting to predict every short-term price swing. As the coming weeks unfold, the silver market will likely continue responding to a combination of economic data, policy expectations, industrial demand, and investor sentiment, making this one of the most closely watched periods for precious metals in recent years.